when it comes
not like this. Not like this, but when the picture was on.
Okay. Well, fuck.
Sorry.
All right, guys. So everyone can see the screen, right?
Yes.
Okay, perfect. So basically, we're going to go over how options work. We're going to start with the basics, and I'm going to go real slow. And if you guys have any questions, feel free to ask right away or just wait till the end of the slide. It's kind of hard to get everything right away, but I think by the end, I think you guys will have a deep understanding of how options work. So basically, what are we going to discuss? We're going to discuss what is a call. We're going to discuss what is a put. We're going to discuss why would I sell options instead of just stocks. What are the risks and what are the advantages? Which specific companies give you the highest returns right now on these risks? How do we decide what strike price and what date? And how we can roll over from different strike prices to different dates, different strike prices to maximize the total profit. Obviously, we always want to make as much as possible, but we always want to limit our risks. So that's what we're trying to find. What comes with the least risk with the most profit? So we're going to start with what is a call contract? What exactly is a call contract? A call is the ability to buy 100 shares of a stock for a specific strike price on a specific date. So your break-even price is going to be the cost of the call plus the strike price. You own 100 shares of this stock at that break-even price in the future. So when you buy a call contract, you're not actually buying the stock. You're buying the ability to buy 100 shares of this stock by that date. On any day by that date, you can technically exercise that contract, and then you own 100 shares of that stock because you've already prepaid almost for the ability, and as the price goes up, it'll go up. So if the stock is under the stock price on the expiration date, it expires worthless because there is no value to buying a stock for a higher price than it is currently. You're essentially paying a set fee for the ability to buy 100 shares of a stock. You don't currently own anything, just the ability to buy 100 shares of this stock. So, the pro of this, the price of this ability goes up at a much higher percentage than a stock. So you can make a higher return on the total capital you're putting in. But the huge con is that you can lose your entire investment if the value is below the strike at expiration. So most importantly, you also have to have whatever the value is times 100 in your account in case the call is executed. Generally, some brokerages, hold that money. Some just make sure you have that. If a call is executed, they'll just start selling your current positions to make sure you can buy that call because you have to once the call is executed. So basically, I'm going to show you guys examples later, and we're going to actually, show the examples. You guys are going to calculate this yourself, but basically, you're going to pay a little bit more with the call. So if the price of a stock is $1, for example, and you want to buy a call with a strike price of $2 or $3, you're paying whatever the strike price is plus whatever the price you're paying because you're paying just a little bit to own it at a higher price. So you're betting that the company will succeed, but you can only start making money once it passes the break-even price. So I know that was a lot of information. Does anybody have any questions on this that could help me clarify it better?
Yeah. You were saying you're just a call is the ability to buy it, so you're not actually buying it.
Exactly. So a call is you're just buying the ability to buy 100 shares. It's always 100 shares. That's why it's called a contract. That's why it's not called shares. The whole point is that you're buying a contract, and a contract is always 100 shares. The
It's only
reason
going to be 100. It's not going to be like 200 or 300.
exactly. So the reason why, for example, Apple wanted to do a stock split is because it made options more easily available. Because with the contract for Apple, you have to agree to 100 shares. So back when the price was like, say, for example, $400, which it was before the split, like you would
that
have
be
to do
impossible to buy
400. Not impossible. Many people have the money, but now
But
that's 100. More people can afford to options trade.
right.
So
Well, a larger base. Exactly.
exactly. So although some people say that the price of a stock doesn't matter for regular trading because it's all about the inherent value of a company, that's definitely very true. But these numbers are very important in options trading because these numbers open even the ability to do it. Because if a stock is under $10, then times 100, that's affordable for some people. But if a stock is $100, that's not one you can even options trade because you just don't have enough in your account to do it. So that's like a big thing to remember.
Okay.
Can you go over this? You must have the value of 100 strike price in your account in the case the call is executed.
Exactly.
You own the call, right?
So you bought.
Have the right to buy the shares,
Yes.
but you didn't buy them yet.
So if you want to exercise them, and that happens, like a lot of times on the platform, you can check off auto execute on expiration. So it just automatically executes it if it's in your favor. So if the price of your call was like, with this and it's over this, it'll just automatically execute it, but you have to have that in your account. So that's like really important. And also because you bought that ability, a brokerage firm often needs you to have that. You can't just buy that ability and then just put the money in whenever you want to, because a lot of times the brokerage firm is set up. But the thing is, they don't hold your money hostage with this, like puts, because with this, you're the one who has the ability. So you're buying the ability, so you don't necessarily have to have the money in cash available. Like you can have.
They're just paying to be part of a club.
In essence, here's the thing. Like say a stock is $5. You can buy a call to get it for $10 for like $1.20 or something. And then you only start making money once it gets to $11.20, but it only costs you $1 to do this. So it's like you can use your capital and get way more, So it's like you're putting less money that is gonna get a higher return. So if you want to get like 500% on your money, that's possible with a call. But if the stock only doubles, then you would only make 100%. So calls are for people that want to take more risks so that they can possibly get more of a reward.
Okay.
But you're not just supposed to execute them, right?
So everything is going to be situational. What I do is mostly focus on put contracts. So we're going to study that further, but I'm going to try to teach you guys in depth how both of these work. And with a call contract, there's two different strategies. Some people buy the calls in a very short-term strategy because they want to buy the call, they want to make money on it like a week later, a month later, a day later, and they just like really believe a company is going to explode, and they really believe a company is going to explode, and they only have $1,000. They don't have $10,000. They want to turn their 1,000 into 5 times that amount because that's what they believe. They believe that with the calls, they did the math and they saw that if the company goes up by 100% in the stock, the call will actually go up by like 400, 500%. So that's when it's in your favor to take that bet. So you really want to analyze what the current conditions are, do the math, and see if it makes more sense to buy a call, more sense to just buy the stock, or more sense to just sell a put. So
is the call for the for Friday will be more expensive than the call for like in 3 months?
Yes. So later in this presentation, I'm gonna show you spreads, and we're gonna read them, and I'm gonna have you guys do the math on them. So you're gonna actually incorporate all this knowledge, and you're gonna see how the price varies. So a call that is gonna be for February is going to be a lot cheaper than a call in May because by May there's more time for the price to go up. So that's clearly more valuable.
So the closer one's going to be cheaper than the further one.
Exactly. And the further ones are less risk. So a company, if you give them a whole year to grow, who knows where they will be for a year. So if you really think this company is going to be like really big in a year, you can buy some cheap calls right now, like 2 years out, 1 year out, and then you can really maximize your return. If you bought NVIS calls a long time ago, you would have made a shit ton of money.
So you're like making a reservation based off what might be profit.
Exactly. So that's what a call is, and the main risk is that if it's under that strike price, you lose the entire bet. So if the stock never goes to that higher strike price that you got above, the whole investment is lost. You can't just hold this like a regular stock and hope it goes up eventually. The whole investment is lost.
So if things are going, like, say you have something for like a month from now or 2 months from now, and then shit starts to hit the fan, it's like not going well, like within the next week, can you like cancel it?
So the price will always go up and down based on. So if the stock price goes down, then the price of your call goes down, and the price of the call will always go up and down. So it's always going to be like a different price based on the current price. So it's always going to be like your break even will always be different than the current price, and it will always go up and down. And also, to buy and sell it is much more complicated than with regular stocks. So we're gonna get all into that. So I think we're gonna go on to the put contract, and and we're gonna go over a lot more deep all this stuff. This was just the first slide. So now we're gonna talk about what put contracts are. So a put contract is the ability to sell 100 shares of a stock at a specific strike price by a specific expiration date. So it's the exact opposite. What you're doing is you're buying the ability to sell 100 shares of a stock at a specific strike price by a specific expiration date. So it's important to remember that you can buy or sell a put contract, and you do not have to own any puts to sell them. I love selling puts, and this is why. By selling a put...
Oh, you're cutting off, Igor.
Someone else was just making some noise, but they muted now. So by selling a put, you are receiving a fee. Because you receive that fee, someone can now sell you 100 shares of that stock anytime before that date. So what you're doing is you're creating a situation where your break-even price is the strike price minus the price you sold the put for. Because the price you sold that put for is your fee that you're receiving. And the strike price is the amount that they can sell it to you. So you're, in essence, getting this stock for cheaper than it is now because you've already agreed to a strike price. So you have a maximum profit. You get an advantage to get the stock cheaper than it is today because you're limiting your maximum profit. You own, quote unquote, 100 shares of this company at this break-even price, but only up to the strike price. You can only collect the maximum profit of your strike price minus the break-even price. So if the price of the stock is above the strike price by the expiration date, you collect the entire fee that was paid to you. If the price is below the stock, generally is executed, and then you will own 100 shares of that stock at that strike price, but you already received the fee. So you actually own them at a lower price, the strike price. It will show in your account that you own it at the amount that it was executed at, but that's because you already got a fee. So you already have that money. So the broker account generally takes the cash value of the break-even amount times 100, because obviously 100 contracts, and then you can't have access to that money because it's on hold if the put is executed. Because what you did was, by selling this put, someone paid you. They paid you because they want to bet against the company usually. And to bet against the company, you have to buy a put. And by buying a put, that way you can start making money once it goes below a certain amount. So it's, in essence, you are, by selling a put, are betting for a company. By buying a put, you're betting against the company. So because you can't just like sell shares without shares being available, shorting can only happen if shares are available. It comes at an interest rate percentages. It's often high. when someone wants to bet against the company, they have to buy a put. So you sell a put to them. You are taking, in essence, a bet against the company. They want to bet against the company, so you're like, sure, I'll take that bet. I believe in this company. They pay you to take that bet, and that payment is sometimes a huge amount, actually, under the current value. So, my whole thing is what we're looking for is ways to make 30, 40, 50, 60, 80% if the price stays the same. That often, not often, but when we find it, that's something we really want to take advantage of. We want to find situations where, people are betting against the company and we're taking those bets because we strongly believe it's going to grow. And we're getting the stock at a lower price than it is today. And we're agreeing to the strike price. So we're ready to make that profit. And we're going to talk about when that makes sense and when that's an advantage to you to do. Now let's talk about this. I know it's a hard concept. Do we have any questions that can help me clarify this? How do you guys feel? Do you guys understand this?
I think we need an example,
Yeah, we're gonna go over that. Yeah, we're gonna go over that.
Like an analogy,
Okay, so that's next. That's next. We're gonna get into the examples. So this is a nice chart that basically shows you the call buyer, call seller, put buyer, and put seller. So buying calls comes at high risk, but gives a high reward because you're betting on the company. You're betting on the company so much that you're getting a break-even price higher than the current price because you don't have to pay the full value. You don't have to pay the whole price of the stock. You just pay a certain fractional price of the stock to possibly own the price when it jumps. You think this company might go up by 500%, but you don't feel so confident that you're just willing to buy stocks on it. You just want to make a small bet. Sometimes this is available for $100. You could take $100, turn it into $500. You could take $200, turn it into $1,000, or you might just lose it. That's an interesting situation. That's when we buy some calls. Selling calls, that comes at a huge risk. There's unlimited loss to selling calls because the price can, go up, and then you make as much loss as it goes up because by selling a call, you're betting against the company. So there's no bottom. By buying a call, the call can only lose as much value as you bought it for. It can drop to zero. By selling a call, it can keep going up and up and up, and there's no way to stop losing money until you get out of that if it keeps going up. Buying puts, it's a high risk because you're betting against the company, and you don't even start making company money unless the company is lower than your strike. So by buying a put, you don't make any money until the price goes below the strike price. So the strike price is often 10, 20, even 30% below the current price. So by buying a put, it's just often the only way to bet against the company. It comes at a high risk because first of all, it has to really drop before you make any money. And if it goes up, you're fucked. Unlimited loss. Selling puts, my favorite. Lower risk because you're betting on the company, but less reward sometimes. So selling puts is a good idea because it limits your risk. The market can drop anytime. We've seen a lot of market crashes. By selling puts, you're creating a pillow for yourself in case the market crashes. If and when the market crashes, now you have all these companies at a lower price. You won't make as much if they explode, but at least you got a pillow to sit on when everyone else is losing everything based on the actual price. So that's why I do it, but it takes a while to really get this. So what we're going to do is we're going to get some examples. But before I want to get into examples, we have to go over some very important tactics, and I got to explain why it's much harder than trading regular stocks. To trade options, the market has no pre-market, no post-market. You can only buy and sell between 9:30 a.m. and 4 p.m. So you literally only have those 6.5 hours to do whatever it is you want to do. You don't have that 4 a.m. to 8 p.m. huge window. And if a price goes way up or if a price goes way down, you can't do anything. You can't start collecting on this profit. And then by the time the market opens, it could be not as high anymore. So you feel like everyone else got to capitalize on this investment and you didn't. So owning a stock does give you the flexibility to buy and sell during pre and post market, which is important. the bid price and the ask price often have huge differences. There's a lot of people selling stocks at that, actual stock, but there's so many different options available that each options chain might only have a few people trading. So you really only trading with like a much lower volume, but that comes with a lot of pros and cons because you're always getting it at a lower break-even price. So you don't care sometimes. I don't really care. I am ready to hold this. I'm ready for this expire worthless. So I'm thinking about this long term, and that's why we do it. It's hard to get the prices you want though. The main example is the high ask price of your put sell order might not fill. You always want to have the highest sell order when selling a put, and you always want to have the lowest bid when buying a call. You don't want to just buy the ask or sell the bid. You want to put in a higher order and take it down slowly, because that's how we make money, by always getting the highest sell orders in when we're selling a put, and if you want to do calls, by getting the lowest bid, because you want to sell these lower bids higher, and you want to buy back these puts you sold lower, and that's the whole point. So you really want to, the same way you don't usually just put a market order in when you buy a stock, you really try to wait for the dip, wait for the go up, and get in on a stock when it's dipping. You want to put that high sell order in, and then you just want to wait for the stock to dip, and then it'll automatically sell once it hits that. So that's really how you want to do this. It's going to take you a while to actually get used to options trading. Yeah, we're going to go over some examples. We're going to look at option spreads for real companies. You guys are going to be calculating the break-even price, and you're going to be calculating your expected return on investment. You're going to decide which strike price and date you feel comfortable with based on the varying level of risk and reward levels with each separate strike price. So are you guys ready? Do you feel like if I give you guys a spread right now, you're going to be able to calculate the break-even price and be able to analyze that?
Probably not. Let's try.
Okay, cool. That's what I like to hear. Okay, so let's start with MVIS, a favorite of ours. So this is the call spread for May. For this, we're just going to do one month of options so we don't get confused. And for the next, examples, we'll do a few so you can see different things. So we're going to start with calls, and then we'll do puts next. I just want to start with the calls so you guys can understand one thing at a time. There is a way that you can see both, but I generally recommend to just look at the calls and then look at the puts, because it can get very confusing if in whatever app you use. I use Webull because it's very well organized, but in Webull you can open up, you go hit the stock, and then there's a little thing, you hit options, and then this will show up, and you can see the options channel, options spread for any stock. So this is what we're looking at. This is for May 21st. The strike, that's the strike price, and you are paying somewhere between the bid and the ask for the ability to buy that stock for that price. So we're going to look at the max available right now, which is 30. So for a call at 30, who wants to go first? I'm going to ask some questions. Oleg or Jack, who wants to go first?
I can try.
Okay, so Oleg, for the strike of 30, you see 30, and then you see that there's a bit of...
It's like around $5.
Okay, exactly. So yes, what you see here is that the bid is $4.90, and the ask is $5.10. That is weird, because the 25 strike is a little bit more expensive. So sometimes that happens. As you see, it's not always like a guarantee. And that's the thing with options trading. There's sometimes things that don't make sense. And as the 19 actually, yeah, no, it does make sense. Everything gets less expensive, but by like different amounts. So it doesn't always go in like, the same increments is what I'm saying. And that's because it goes from 25 to 30. So that's why there's such a big drop, but it's not as big as you would have expected for 5. So the price to buy 25 and the price to buy 30. Tell me what you could expect to purchase a call for 25, and what would you expect to purchase a call for 30 here per,
So like $500, no?
Yes,
For the
exactly,
30?
exactly. So for 30, you're looking at between $490 and $510, and then for the 25, you're looking at between $580 and $600. So that is how much it would cost you to purchase a call for that date. So if you were to purchase for $500 this call for $30, when do you start technically making money, and what price is your break-even point? What is your break-even on that?
It's like 30 plus 5.
Yes, so 35 is going to be your break-even. So if May 21st comes and the price of this stock is $36, then you make $1 per share.
$1.
But if the price becomes $35 in 1 month, then that's going to be worth way more than $35, because people are always going to pay more to have the option to buy this. So you're always going to go up by a high amount, because by the time that it would be $30, it would be something more than what we're looking at for 18 right now, because the $18 calls are $7.50 right now. So to buy this stock for the same exact price as it is now, but in May people are willing to pay $7.50. So if you were to pay $5.10, then people, by the time it's 30, and this is going to cost like way more money, and it's going to cost like significantly more than $5. So it could possibly cost $10. It could possibly cost $15. It could possibly cost $20. So with MVIS not even doubling, your investment gets doubled. So you could take your $500 and then turn it into $1,500. But if you were to only buy $500 of MVIS, even if it doubled, your 500 would only turn into 1,000. You can't turn your 500 into 2,000 otherwise. But you risk losing your entire 500. But because we believe that MVIS might actually go to 50, might go to 100, there might be a reason to do this. There's a lot of talk about this LiDAR like really blowing up. And if you have a limited capital, you might want to put your 500 here, because that might be the only way to triple, quadruple it. So the calls give you that option. The calls give you that ability to take a higher risk, but to make a much higher amount. So yeah, what about Jack? Jack, are you ready to take a question?
I'll take a question, but I'm still like trying to soak this in.
I understand it is complicated. It is complicated. So for you,
I get what you're saying though. Like if the bid is $4.90 and the put ask is $5.10,
it's exactly like when 10. You buy a stock. You're gonna want to get that ask. So you're gonna put a limit order for that ask, and you're gonna slowly go towards the bid, the same way you would do with the stock. So for you, let's look at this spread. So 18. Say you buy a call for 18. How much is that going to cost you?
What, $730?
Yes, between $730 and $770. So that's what buying calls is, and it seems like you guys have a good understanding of that. So we're going to go on to a puts for MVIS. This is very exciting. This is what I really like. So this is the put spread for May. So what we're looking at right now is, this is how much money you get paid to have somebody be able to sell you this stock at that strike price anytime. So this is really interesting here. We're going to look at different options. So let's look at the strike of 23. Let's look at the strike of 23, and let's look at what that means. Let's do Oleg. Oleg, we'll go first again with you. What is your break-even price if you sell a put at strike 23?
It's 12. Like 12 something?
So it's going to be, this is the thing. You're going to get in between $1,100 and $1,210. So rather than that costing you that, you get in between that amount. And then what happens when you get that amount is that your brokerage is going to put on hold Whatever the money is, 23 minus that. So let's look at the last sale. The last sale went for 11.20. So we're gonna go with 11.20 because that's the price it actually sold for on that date. So with 11.20, that person got the premium of $1,120, and by getting that premium, now they can sell them that stock for $23 anytime before May 21st. But now that person has a break even of $11.80. So they're actually owning MVIS right now at $11.80. And if the price gets to 23 and sticks to 23 by May, they're gonna get that full amount. So we're looking at almost 100 or even more, like basically almost 100% profit, 90% profit right now. And the price at MBS for them to make 90% profit only has to go from 18 to 23. So what kind of rise is that from 18 to 23? How much of a percent up is that?
I don't know, like 5%.
It's still a significant percent. So for it to go from 23 to
like 30%, right?
Yeah, so 5 divided by 18. So it has to go up by 27%. But if the price of the stock goes up by 27%, you still, though, are going to make almost 100% profit right now because you're making like 60, 70% profit on stagnation. So if MVIS explodes, you're not going to make any profit over 23. But the beauty of this is you're going to make all the profit between 12 and 23. And all you have to invest right now and have on hold is that per contract, the $1,180. So this is what I love. This is what I love because you can make money on stagnation. Now, let's talk about a different option here. Say you want to take a little bit more risk. Jack, we're going to go with you. On the strike of 30, if you wanted to sell a put on 30, what's your break-even price? And, what's your break-even price?
For 30,
yeah.
Well, when it's not going to be 1675, is it?
It's going to be the strike minus the price you sell it for. So you're going to sell it between $1,620 and $1,730. So you're going to get that.
So my break even would be like 1340, something like that.
It depends on because that's the thing.
In between there.
You don't know whether you're going to get something at the ask or something at the bid because the highest someone was willing to pay right now is 1620. And the highest someone is willing to pay right now is 1730. So you're going to put in 1730. And then every 5 minutes, you're going to put it down by 10 cents. And you're going to keep putting it down by 10 cents until an order processes. And then that's what you're going to get.
Every, 5 minutes?
It depends. Everyone has different strategies. But I don't just sell it at market value because that would be crazy just to sell it to the person who's willing to pay the cheapest. You're going to want to monitor the movements of the stock. And you're going to want to already have a high ask in so that when the price goes down, it executes. And you're thinking long term about this because you already own the stock cheaper. So all you have to do is hold this because by May, if the price is more, you get that whole premium. And if the price is less, you get whatever amount it is, minus the premium. So you're already in at that break even price. All that matters to you is that break even price.
That's a lot of cushion, yeah.
Can we go like exactly like step by step? For example, I decided to buy strike 20, right?
So always use the word sell.
I decided to sell
because it's very important. Yes.
For strike 20.
Okay.
So I'm looking. Okay, I see 860, 950, right?
Yes.
So I start with 950.
You're gonna put a sell in order for 950. Correct.
Yeah. What does it mean? It means I need to have $950 in my account by that time, or
yes. So actually, that's very strange. But the way brokerages are set up, initially you would actually have to have 1050 on your account. They look at that amount. For some reason, when you put it in, you have to have as much as it all is, and then after you get paid, then they hold the money like hostage. So it's kind of like the way the brokerage is set up is in your account right now. You're gonna actually have to have $1,050, not 950, and then
so it's like 2,000 minus 950. That's what I need to have
initially, but then right after you sell it, you get the 950, and then it's like you have to have whatever it is, like a little bit more. It's set up in a weird way initially, so you have to have a little bit more, but then once you sell it, boom, all that matters is the break even. You have to have the break even times 100.
But you sell it. Well, for example, I choosing this one. I'm pressing whatever 940, right?
Okay, yeah.
For example, 940. Once I sold it, it means somebody bought it, right?
Yeah.
What happens? You're saying that first my account before to sell the put, I need to have 1,150, right?
Well, actually, no. Let me see real quick. 1 second. You right here would have to have the break even after it sells. They hold the break even times 100. But before it sells, you actually do have to have the ask amount. So for some reason, the way it's set up is before you actually get the money, you have to have that much in your account, and then after you get the premium, they only hold the other side hostage.
When you sell it.
When they sell it to you, they process it as cash that you got already. So they give you that cash, but then hold the other side hostage. So they give you that premium, but they hold the other amount on hold. You're gonna get.
What's that? It's 950.
You're gonna get 950 right away.
940.
Yeah, you're gonna get 950 or 940 right away, but then you have to have the 1,060 on hold. You're not gonna be able to use that 1,060 because they can sell it to you at any moment, so they have to put that money on hold because that's what you agreed to. So you basically own that stock at that price, but then you also got paid that. So your account kind of like is like it shows up different in every brokerage firm. So I can't guarantee it's always going to show up the same in each trading platform. But all that matters here is your maximum risk. So your maximum risk is the break even. So if it ever goes down to that price, then you're going to own that stock at that price, and then you can continue holding. But you can see why this is a less of a risk. You can see why selling puts gets you the stock cheaper, but it just limits the amount of profit you can make.
Okay, I understand. I think that's like something strange because it's too much safer, and I don't really care about profit restrictions. Because it looks like as long as for example, if MVS doesn't fall to 20 minus 950, what is this? If MVS doesn't fall to like $11.50,
yeah,
you still will make money.
Exactly. You make all the money between the break even and the current price on expiration. So say the price of MVS doesn't move at all. It just stays at 1833. You're going to make your entire premium. It's just you're going to lose the difference. So you're going to lose $160 some dollars. So you're going to make the $940 minus $160. So this is the way you make money from it staying the same.
Okay, interesting.
And it's a lot of money. I mean, what else is going to make you 60 to 80% when the price stays the same? And
but who's buying those puts?
Oh, machines. No one in their right mind would. So what I do is, I look for opportunities where robots are buying excessively expensive puts and taking ridiculous bets against their favor. So this puts you at a huge advantage. And if the market crashes, if every stock crashes, if everything just goes crashing down, and MVIS is at 10, and you're only going to lose $100. But if you bought MVIS right now, a shit ton of shares, you would lose a lot of money. So this is like limiting your risk in case of a crash. This is like when you're nervous the market is going to crash, but you still want to make money. Kind of good strategy.
Okay.
Hey Igor, it's Jan.
Hey, what's up?
Quick interjection. I'm alive. So when you did your calculation of $160 loss, you took the strike price and you subtracted it from the current price, so 19 minus 1833.
So what you're looking at is your break-even price. So say you sold the put for $9.40 at the strike of 20 that we were talking about. So you got $940 for that contract, and then your break-even is going to be $10.60 actually. So with that one, you're actually good all the way to 1060. So with that one, even if MVIS goes down to $11, you're still making $40 profit.
Okay.
But it will show up as negative for several months because the prices of the put will fluctuate greatly. So in your account, it will show up as negative because in your account, all that you're going to see after you sell this put every day is just going to be the average between the bid and the ask. And there could be some ridiculous bids and asks that are not realistic at all. So even if in your account is showing up as hundreds negative, it will change. That put will expire worthless if that is at the strike price. And that's the beauty of this. You can just make a decision and then just wait. And then even if the price goes down, you're still probably going to make something. And, even if it completely tanks, you're going to lose way less. And if it goes up, you're going to make what you already planned for. So this is really good to own on top of your stocks. So you can invest in MVS, buy a bunch of stocks, but then you might be a little nervous. You might feel, I'm a little nervous to buy more. What if the market crashes? This gives you a way to buy more, even though you're nervous, because you get in lower. And when you can get in lower, you're willing to get more, make a different kind of bet,
So after you sold the put, what are your options? You can hold it till May 21st, till the expiration, right?
Or you can rebuy it whenever you're happy with the current profit you got from it. So if MVIS, for example, you sold this $20 put, say MVIS jumps to like $30 like next week, say it's already at $30 next week, the price of the put will drop. It will drop significantly. We don't know exactly what it's going to drop to, but it's going to drop very significantly, especially if it goes to 30. So right then, you can take the profit and then roll over the profit. So we're going to go into strategies of rolling over the profit. You can always buy it anytime the market is open at a cheaper price to take the profit that day.
Mm-hmm.
So we're going to go next, and we're going to talk about another one. We're going to do OPTT next. So OPTT. So you guys were, I want to teach you guys about how the months will affect the price. So now we're looking at an option spread for OPTT. And this is the call spread. So now we got February calls, we got March calls, and we got May calls. So 19th of February is very, very soon. So the calls are very, very cheap. A call for February 19th was going for 10 cents to 15 cents. But then by March, it goes all the way up to 80 cents and 85 cents. And then by May, they're pretty high, 165, 180. What does this mean? Is this good? Is this worth the risk? We'll ask Oleg first. Oleg, what is the break even right now if I was to buy a call for 7.5 in May?
For 7.5 in May, the break-even price will be 7.5, right?
It would
minus
be. It would, yeah.
1 minus 1.7.
It would be plus. It would be plus. We're doing calls again. This is calls again.
Oh, this is calls. Okay. So it's okay. So it's 7 plus 1.7. I don't know. It's gonna be 8. 9.6 or something.
Exactly. So if May, once it hits over that break even, you're definitely making money. And every time the price is going to go up, it's going to skyrocket. So if you were to buy this, for example, 170, and OPPT doubled and went from 520 to 1040, it would way more than double. So if you only had say $200 to invest, you only got $200 to put into something. For $200, you can actually get a contract of OPTT, and that could triple, that could quadruple if the price of OPTT only doubles. So this is an exciting way to triple to quadruple your low investment, as long as you're willing to risk losing that whole investment. It's if OPTT does not hit 7.5 by May, you lose everything. But if it does, you'd make way more than if you would just buy the stock outright.
Why the strike price here goes by $2.50 and there it goes by $1?
So the market creators are responsible for all of this. New strike prices appear every day, and it really depends on the price. Once OPTT hits 10, the market makers are probably going to give new strikes. So they're going to have 12.5, they're going to have 15, they're going to have 20. And on those days, we need to take advantage, and we need to take our current profit, and then we need to sell new puts or buy new calls, because once these new ones are available, these are new and exciting options that we can make money on. So I mean, I'm the type of person, I really want to maximize my money. So I'm really trying to get the max, and when new maxes are available, I'm going to roll over into those new maxes. So this is all very exciting. OPTT did not have options trading at all. This is very new. This just started like 2 weeks ago, 1 week ago. So this is a very new option that's only been available very recently, and you're going to see more and more and more decisions from the market makers above to add new options into the market.
That's why the return is so ridiculous.
So a lot of times bots are going to make the options based on the moving averages, and a lot of times with bigger, more expensive companies, it's very low percentages. There's no puts that you can just sell and make like 50 to 60% on just stagnation with bigger companies, because that's crazy. Everyone would love to take advantage of that. So what we're looking for is opportunities with small companies that we believe in that still have really high percentage returns on stagnation for puts, and really high potential for calls, because you have to find calls that can double and triple. You don't really care about a call that's going to get you a similar return to when a stock goes up. You're looking for companies that might double and triple, and you're looking for calls that are going to more than double and triple your money. You can sometimes 10 times your money when a stock only doubles or triples because you bought the right calls. So what we're looking at, we're always doing math, and we're thinking about how to maximize our investment. I'm very nervous with calls. I don't like calls because if it doesn't hit that price, you lose the entire investment. I like stocks and selling puts because no matter what, I can hold it. I can just keep holding it and it'll eventually go up. With a call, you lose everything on that bet. So it's not necessarily for me, but I do see the advantages, and I'm teaching you guys the advantages.
Oh, hey, Igor, let's go back to your example where you said OPTT hits 1050, right?
Yeah.
So your break-even point at 7.5 May 21st, that would be 10.5 minus 7.5 plus 1.72.
Okay, so let me explain to you this. Your break-even point only is there, like, you decide to buy or sell an option, and then that's your break-even point. That never changes. That's your break-even point. The break-even point of the new options available are going to change.
No, I understand that. So I get that. So in this case, it would be 10.5 minus 9.22.
Yeah, in this case, that would be your current profit if it would stay the same price by May. But when it goes up that much, the call values go up by huge. Like if it hit 1040, the call would no longer cost $1.70. That call would be worth like $5, $6, $7.
Okay, so that's just something you have to track.
That's the thing. You don't know how much a call or put will go up because it's really like based on things outside of your control. There's certain Greek algorithms. You can look at like different mathematical Greek algorithms that you can see the delta, the theta on it, and you can try to calculate what we're looking at. But at the end of the day, you don't know. It's more of a risk trading options, but it's also more of a reward sometimes. So
that's interesting.
Yeah. So by buying a call, you're taking more of a risk, but you're able to get like a higher reward. And by selling a put, you're taking less of a risk, but you're also limiting your reward. If you will sell a put and your maximum gain is 130%, but then it ends up tripling. You don't make the 300% if you had just bought the stock. So it's always, you really want to do everything and analyze and use to leverage. Some companies will do both calls and puts against each other, just so they're guaranteed a small percentage. So you could also play it that way, where you do options trading and you do both, buying calls and buying puts, so that you make a small percentage and just guarantee yourself a small percentage. And
right, that's essentially hedging.
Yeah, and also you can sell covered calls. So rather than selling a call with unlimited profit, you're actually selling calls based on stocks you own. So you're only risking the stocks you own. So there is more options beyond the ones I'm teaching you. These are simple options. And then on top of this, there's even more options in options trading, selling covered calls, all that. But we're not going to go into those complex things. So Jan, I think since you jumped in, I'm going to quiz you right now on some things to see your understanding of this. Let's look at March. On March.
All right, I'm ready to fail. Let's go.
It's in March. If I wanted to buy a call in March for $10, strike price, how much would that cost me?
How much would that cost? So it would be between $500 and $550.
Exactly. And for March at a 10 strike price, the risk here would be that if the price of the stock does not double, you lose that entire investment. And that's not something I would be willing to do. But to some people, they're willing to play those risks. If I was gonna buy any of these calls, I would want to buy something way out in May or even in August, which we're not even looking at, because I think this company has a lot of potential. But I would want to just give them some time to grow, because this company could have unlimited growth as long as it keeps succeeding. So you can look at the call options, but we're gonna focus more on the puts. So let's talk more about the puts. This is the put spread. So now we're looking at the puts for this. Who wants to be asked some questions about puts? Who's ready?
I'm ready.
Okay, Oleg, perfect. So looking at these puts, what I think is great for puts is doing something more far out. So I love doing stuff for May, maybe even August, at least March. I'm not gonna even look at February. That's way too soon. So we're gonna look at May. What's the break even right now? May, $10.
So the break even will be like around $3.80.
So it's very difficult to know whether you're gonna get a $6 or $6.60. So if you were to sell it for $6.60, then it would be the 10.
I mean $3.40.
Yeah, so you would have between $3.40 and $4 as your break even. So in this situation, that's the break even. But then we have 7.5, then we have 5. So now we're gonna take it to you, and I want to ask you, if you were gonna sell a put on this company, which date would you choose, and which strike would you choose, and why? Why would you take that risk, and what would make you most comfortable here?
Even 5 is good, right?
Yes. Looking at this, it's actually very appealing, because when we look at 5, we're gonna make a very significant percentage. How much exact percentage on investment are you gonna make on the 5? Try to do that calculation, and then I'll tell you if you're correct.
Like 40%, no?
Even more, because we're not looking at 5. You're only investing 5 minus 215. So you're only putting up about like 285. And then your max return on this is going to be 215. So this is a huge way to make almost 60% on your money on pure stagnation. It can even drop to 5 and you're still going to make that full amount. So yes, that is incredible. I would highly recommend selling a $5 put on this so that you can make a ton of money.
Let me go get so I'm buying the put for.
You're selling the put.
I mean, selling the put for $5 strike.
Yes.
I'm getting paid premium around $210 or $215.
Yes.
So like $216.
Yes.
And if it stays at $5, I still gonna make this $215.
All of it.
Right?
You're gonna make all of that $215, and all that you have to do is the program is gonna hold your $285. They're gonna hold your $285, and you're gonna make that $215. So let's do the math on that. What's $215 divided by $285? We're talking about 75% here, guys. We're talking about 75% on stagnation. That's incredible. So this is a way that we can guarantee almost ourselves 75% on our capital as long as the price just stays the same. It's a kind of a risky company because it's new and it's had a lot of growth, but we're talking about a lot of potential here. So it would be a beautiful thing to do this and buy stocks. You can buy stocks in this company and sell some puts. So you can make a safe bet and you can make a risky bet.
Let's see if the price goes, for example, from current 520 to 10.
Yes.
And I bought this put I sold this put for $5 strike.
Yes.
So it means I'll make 10 minus 5.
No.
Plus 215.
No.
Plus 215. No.
So you don't care if the price goes up because you don't get any extra money by May if the price goes up. The only thing that happens if the price goes up in the short term is it's not going to cost $2.10 anymore. It's going to cost like $1. So if the price goes up by, to 10, and then the new price of the bid and the ask is going to be, say, 80 cents and 95 cents. Now you can either wait to get the additional $80 by May, or you can just take the money you just made, which is going to be a lot. It's going to be like 60-70% of that, and then you can just make a new bet. So what I do on the jumps is I just take whatever the new price is. I buy it back in. I take whatever profit I have there, and then I just sell new puts that are more risky at higher strike prices. So you don't make more money if it goes up. Your maximum amount you can make on this is 75%. There's no way for you to make more than 75%. But you're going to make 75% no matter what, as long as it doesn't go under 5.
75% of what?
Of your investment capital. The program holds hostage $285. And until May, you can't use that $285. But you're going to get an extra $215 because of all this, the premiums. So this is a way of you holding some money hostage, but guaranteeing a huge return of it. I think this is great. Because with an ETF, it might go up, it might go down. But here, you're going making money if it stays the same. So in my opinion, that is in some ways safer than an ETF, because in an ETF, you're still relying on companies to go up. And an ETF is only going to go up if the markets all go up. In this situation, if the markets stay the same, exactly the same, and the stocks stay the same, then you're still making money. So that's the benefit here.
Okay, so you cannot make on this selling this put, you cannot make more than $215.
Exactly. Yes.
Okay.
Just to interject for a sec, so it sounds like you're guaranteeing a future price, a future strike price. So in this case, $5 is the guarantee you make.
Exactly. So what you're making money below. You're making all the money between the break even and 5, and that's what you're doing. You're limiting your profit, but you're creating a very safe situation for yourself. Most people who start trading think that the only way to make profit is if a stock goes up, and they don't realize that there's options, and these options allow you to make money on stagnation, and it's usually not this nice. We just found a golden opportunity here. Usually it's only going to be 10%, and then you have to put on hold like $2,000 to get that 10%. And that's the thing. These are beautiful options, and these are once in a lifetime opportunities. These are not available every day. It's very difficult to find a guaranteed 75% on stagnation.
Now? Why such a difference in the market now?
Well, just you have to have companies that are the right price. Once a company's like over $30, everything changes. No one sees that company as risky anymore. All the puts won't get you much. They're only going to get you at a break even like 10% less, 20% less max. Like big companies, everyone knows that they're probably going to succeed, so it's not like any risk. No one wants to take that bet against you. Like to have this work in your favor, someone has to take that bet against the company. And these are ridiculously high prices. This is crazy. You're making 70% even if a company stays the same. This is obvious, you guys get it. It sounds like you guys are processing
So
it.
you're actually looking for companies and stocks that you don't really want to see a crazy amount of movement.
No, you want it to move because once it moves,
Okay.
you can take this profit and roll over the profit. You're gonna rebuy these puts the second you think it makes sense, and you're gonna resell puts for a different strike. You're always
so you'll
gonna
just keep rolling over
exactly
further
that.
up.
We're not
Okay.
gonna wait till we don't want to wait till May, but we also want the cushion. We always will create a new cushion, and we're always gonna create a new cushion. And if the price starts going down and we're happy, we just keep selling more puts, bring our break even down that way. You can have as many contracts as you want, so you constantly can keep adding contracts and keep getting your break even until it starts going up again, and then you make a shit ton of money. So I mean, everyone.
Igor,
Yeah.
I just want to make sure I got like the fundamentals. So at a strike of 5, when the price goes to 7, you're giving someone the option to still buy it at 5.
So with this is a put, and with the put, it's the option to sell. And by selling a put, somebody else has the option to sell to you. They're prepaying you for the ability to sell it to you at that price. So by buying a put, you're betting against the company, and by selling a put, you're betting for a company. And by selling a put, you're taking a bet against the company, and that person, for some reason, believes the company is going to fall. And they can only really start making on that fall when either the price of the put goes up or it ends at the break even. And this is actually a huge issue. A lot of people want to bet against the company, but there's no shares available to short. So that means you can't just sell shares you don't have unless they're available. And when everyone wants to do that, the interest goes way up. So the only way they can bet against the company is to buy a put against it. And the puts, they're not guaranteed to go up. Sometimes someone could buy puts to bet against the company, and the price keeps falling, but the put price stays the same. Like, it happens, and that's the beauty of this. Sometimes I'll sell a put, and then the price will stay the same, but the put will be, like, way less expensive because the bots made a mistake and sold it to me at a higher price than they should have. They weren't calibrated correctly. Like, with this, you can find a lot of games to play to make money that you can't with regular stocks. So it opens some interesting doors. So I'm teaching you guys. You're gonna play around with it, and you can now judge whether you want to do this or just buy the regular stock or do both.
So what are the qualities you're looking for when you're buying puts? What are like?
So what I'm looking for? That's a great question. I'm looking to be at least at a break even 20% to 40% under the current, and then I want to make another like 50 to 100% above. So I'm personally going to take more risky bets, get a strike higher than the current price so that I have a lot of money I can make, and I can make some below. Because, honestly, if you're like me, you're going to want to take some profit, and this is an amazing way to get in lower and then just have an already agreed amount of profit to take. And then in a situation that it goes up, then you can just already take that profit and roll over. So we're going to do one more here. And this is another great company. We've been talking a lot about Jivo. Now we got calls, and we're going to do puts next. So we'll start with the calls. Someone can go first. Who am I going to quiz right now first for Jivo calls?
I mean, I don't mind doing it. I'm not exactly like on the same page. Like,
no, but it's good.
Learning,
that's the whole point of these quizzes. I want to test you so that you can really get this. So looking at this spread, we got a bunch of calls. So what's our break even right now for a March $25 call?
See, March $25 call. Can you run through with me on how to figure that out again?
Yeah, so what you're going to do is you're going to add the strike price and whatever price you buy it for. So let's just do the last price right now that's listed here, 96 cents. So your break even would be the strike plus the last. So what is that going to be?
Okay, so that'd be $25.96.
Okay, so we're going to multiply so $25.96 is your break even price. And how much is this call going to cost you?
It's going to cost me between $25.90 and $26.05.
No, so it's going to cost you $960.
Oh.
Well, I mean $1,000.
About, yeah, roughly. Somewhere between. So
okay,
we're looking
so
at
run me through that again. Okay, so why does it cost $1,000?
So you're going to pay somewhere between the bid and the ask. The last was 96, so we're going to say 96. So you're going to pay 96 cents a share, and the contract's 100 shares.
Wait, so it's going to be $100, no?
Okay.
$100, not $1,000, $100.
Well, yes, $100. My fault. I should not have said that. It's a complete mistake. Yeah. So it's going to be $100, or roughly $96 for that call. Yes.
Right.
Okay.
And
because it's times 100, I get it. Okay.
Exactly. And
right.
if GVO does not,
because it's a call, yeah.
And if GVO doesn't hit $25, then what happens to your $96?
You lost everything.
You lose it all.
Okay. And then if GVO hits 30 and you have auto execute and GVO stays 30 and it's March 20th, what happens?
If GVO stays 30,
if it gets to 30 and
20th.
stays there, yeah. If it hits 30 on March 19th and then it's March 20th and you have auto execute, what's going to happen?
Not sure.
So what happens is you're gonna own GVO. You're gonna own GVO for $25.96. You're gonna own 100 shares of GVO for $25.96, and now it's 30. So now that happens. But by then, it always makes more sense just to sell the calls because the call is always gonna be more. It's always gonna be more than the current value. So you don't want to just wait and expire it. When it gets to more, you want to sell it and you want to take that profit. Okay.
I see.
Okay.
Now,
who's buying calls?
People that want to take a high risk to get a more high return, but I think it's risky. It's risky because
but risk is so much more than the return.
I agree. So yeah. I like puts more. So we're gonna focus more on puts because that's what we're doing. I want to talk to Jan. Jan, are you here? I want to quiz you again. Make sure you get this.
I'm here.
Okay, so Jan, we're looking at the GVO puts right now. Let's talk about, let's say, May. So for May, and we'll do a $10 strike because it's like easier math that way. $10 strike for May. You sell a put. What's your break even?
Is that 10 minus 2.62?
Yes. So if you want to look at the mid, but we'll just look at the last. So it's easier math. 10 minus 2.6 on the last.
2.6.
Yeah. So what's your break even?
So 7.40.
Exactly. So your break even is 740, and you make all the money from 740 to what? 10. So what is your return on investment here?
So it would be 10 minus 740, so $260.
Yeah. So your return would be 260, and then that would be divided by how much you're putting up. So how much would you be putting up? How much would the
250, between 250 and 275?
No, so the amount
750.
So 740. So 740 is the amount.
740.
So the 740 is your total investment that they're gonna hold, and then 260 is what you're gonna get. So we're gonna divide 260 divided by 740.
Okay, thank you.
So
Wait, so it's crazy. So if I would have like millions of dollars, I'll just sell puts.
That's what I'm saying. This is a good way to make money on stagnation.
No, if you don't care about, like, if you don't have unlimited capital.
That's the thing. This is amazing for people with unlimited capital because it's a much higher and safer return than mutual funds, bonds, ETFs. In my opinion, the risk here is very low because the price of the stock would have to go down by 50% for you to lose, and the price just needs to stay the same for you to win, and that's a huge advantage. It puts things much more in your favor.
What's the catch then? Why is not everyone like doing this?
Is
it because of the capital?
It's all very much so because of the capital and the lack of knowledge. I mean, this is a very complicated concept to grasp. So it took me a while to grasp it, and now you guys get it. So now you guys can take advantage of a deep understanding of a new thing. Like to do this, you have to kind of be a professional, and most people don't want to be a professional. They just want to make simple decisions or get somebody to make complicated decisions for them. But we all know that the maximum profit is going to come from the people that work hard and learn and make always the best decisions. If you're just buying and selling stocks, you're not maximizing your profit. You have to do options if you want to maximize your profits. And honestly, it doesn't always help, because by selling puts, you're not going to always make as much as on the stocks. But for me, safety is very important. I love safety, and this creates a lot of safety.
Are there options for OTC market for the?
No. So Jivo and OPTT just started doing options, even after they were already like several dollars. It takes a long time for options to become available. I've been waiting months for Jivo to have options. Months I've been waiting on.
Is there like official announcement? Okay, today those stocks
Honestly, I'm not sure. I've been waiting for Jivo, and I had no idea until it was mentioned in the group, because I had forgotten to check for a couple weeks. And then when I saw it, I immediately sold. I did the math on these. I saw how amazing they were. I immediately sold them. Like this week, I sold Jivo options on Monday. I sold a lot of puts. By Friday, the prices had dropped so much. I took my profit and I rolled it over. I made a ton of money. And then I reinvested a lot of it into new strikes for a later date. So I'm constantly selling a ton of puts, and I'm constantly rolling it over because I like taking less risk, and the amount of return I've been getting, in my opinion, is very comfortable. Because like you guys have shown, I've shown you guys a lot of examples. You don't have to wait 3 months for that money. It's just that's your maximum. For example, 75% or even 130%. And if that 75, 30, 130% comes out and you already get half of that in a month, you don't have to wait the other 2-3 months. Just take half of that, make new bets. Always think about how much you made in a week or a month in comparison to how much longer you have to wait and cash in. Like if you've already made half of your maximum profit, you cash in faster, and it makes more sense to cash in and roll over, and it always gives you a break even lower. So this way you can always make money and get in lower. So it really gives you a nice pillow to work with,
Can you give us an example of like exactly, for example, you bought for this Jivo, for example.
Okay, I'm gonna go into my account right now. Yeah, bear with me, and I'm gonna tell you exactly what I did this week, so you guys can see what I did this week.
Yeah.
And then you can try to incorporate that into your guys' tactics and what you guys choose to do. So,
Igor, can I ask you a question before you move on?
Yeah.
There's one simple concept that I'm having trouble grasping, and that's okay. So with the puts, you want the price to go down, right?
Yes.
Okay, so for a strike price of 15, right now it's below that price. So how does that work?
So what it is?
So on May 21st, strike price 15.
Okay, so for 15, what you're looking at is you're getting paid between $570 and $600, so that somebody has the ability to sell you Jivo for $15 anytime between now and May. So you already are getting paid right now $570 to $600, and then they can sell you
minus 40 cents. No, minus 40 cents because it's 14.60.
Yeah, like wait, which 40? What are you talking about?
So he's saying that the current price is 14.61. The strike price is 15. So the strike price is higher than the current price.
Yeah, but that doesn't matter. So you're gonna find your break even, and your break even in this situation is gonna be around like basically nine something. But
yeah, 920. Okay, 9.
Yeah, so
913.
So with that, your break even is 913. So until 9/13, you don't have to stress, because come May, you're making all the money between 9/13 and wherever it's at in May, up to 15. And anytime it's over 15, then you can't make any more technically. But here's the thing, like right now it goes down. So I'll tell you what I did this week, and then you'll be able to understand where you can make money right away on this. You don't have to wait till the expiration.
Well, hold on, because this seems really interesting. Because for the strikes that are under, you want the price to go down, soon. But the strikes that are above, you just need to make sure that they don't reach that price. So, like in a bull market right now, most likely the price on Givo is going to be going up, right?
Yeah.
So, wouldn't it make sense, or it's probably less risky, to choose a strike price that's higher and hope it doesn't reach that strike price within the allotted period of time?
No. You're confused. You want it to go up, because as Givo goes up, the bids and the asks all go down. Everything goes down dramatically. The second Givo starts going up, all the bids and asks go up. So once Givo hits 25, those are not going to cost $13.50 to $13.80 anymore. Those are going to cost between like $7 and $8 probably. So you're going to get like a significant change on all of those. When Givo goes up, all the bids and asks go down. And you're going to want to rebuy all those things you sold. You're going to sell those for $13.80, for example, $13.70, $13.60. But then when Givo hits 25, you're going to rebuy those for like $5, $6, like $8 max. Like, you're going to rebuy those the second you can, and then you're going to sell new puts that are going to be available. The new puts that are going to be available are going to be, sorry about that, I just did that by accident. The new puts that are going to be available are going to be for like 30, 35, 40, and you're always going to want to roll it over.
So when you sell a put, you don't care if the price stays down or the price go up. You only care if it falls to, for example, your strike price minus your premium. Right?
Exactly, for long term. But you do very much so care. You want the price of Givo to either stay the same or go up, because if Givo goes down, your puts go up in price. So your account will show you as negative, and you are negative because you cannot sell those puts at the same price that you sold them. Now they would sell a lot higher. So it will show until May that you're pretty negative. And then time decay helps you. If Givo stays the same price, the puts go down. They go down. If Givo stays $14.60 a month from now, those puts are going to cost way less. So you want Givo to.
So you're making less money?
No, you're making more. You sold them high, so you want them to go down. So those puts for Givo, for example, 15 May is now 570.60. If Givo stays the same, by March, those are going to be way down. Those are already going to be like 450, 470. And even though Givo stayed the same, you can already cash in a significant amount of profit. So you're constantly in a position where every month you're going to make more and more profit, and then whenever you're ready, you cash in on it and take the money. So you don't have to keep it until May. You can cash in anytime. And if Givo stays the same, you're making money on time decay. You're making time work in your favor here.
Okay, when you're saying cash in, that means you got the premium, for example, for $50. You got $587 right away.
Okay, so right? I'm gonna tell you what I did.
Let's show you what you do. Yeah.
I'm gonna tell you what I did this week. Exactly what I did this week, so you can understand. So look. On February 8th, I got a good feeling that I need to sell Givo puts. So on February 8th, I sold Givo 15 for $7. I sold another Givo 15 for $7. I sold another Givo 15 for $7. So I sold 3 Givo puts for $15 Givo 15 strike at $7. And then the 12th came around. everything was looking nice. I was like, I'm gonna take this money right now. So I bought one for $6, I bought one for $5.90, and I bought one for $87. So then I made the $100 plus $110 plus $113. But that's not all I did. Also, on the 8th, I sold a 1750 for $9, and then that 715 was already lower, so I bought that in for $770. So then I made $130 on that, and then I also was feeling kind of good about Jivo, so I sold some 1250s. So on the 1250s, I sold those for $490, 3 of them. And then I bought those for $420 on the 12th. So then I made, about $70 per that. So 70 times 3, $210. So I made all that money. And then I transferred it. I sold 3 contracts at 25 for $1360, $1370, $1380. And then I sold 2 contracts at $22.50. One for $1160, one for $1150. So what I did here is I made a bet. I sold the 1250 to 15 range ones, and then they brought me a nice return right away. I took that money, and then I made a more risky bet. I sold for 22.50 and 25. So my break-even price now is going to be higher, but I'm having a possibility to make a lot more money. I know I just said a lot. Did you guys get that?
Okay, basically your system is like you buying first cheaper strike.
Yes.
And as the price goes up of the stock, the price of the put goes down.
Yeah.
Right.
Yeah.
And you cash out the difference.
Yeah.
And then buying more risky one because the strike price is larger.
Yeah, like on this bet, say the maximum profit was like 80% or like 60% or something. I already made like a bunch of that. Say, even if I only made 20% of the most, I made that 20% like in 1 week, for example. So if 1 week I made 20% of my max profit, I'm going to take that. I'm not going to wait another 3 months just to get another 80%. I'm going to put that into something more risky and, have like a little bit of a higher break even, but I'm going to, again, be in a new situation with a new bet. And this new bet might be actually 130% of my capital because it's like a much higher strike price. So I'm always like, thinking about what makes sense and like rolling over. But everyone has different thresholds for safety. Some people just want to guarantee 30%, and some people would rather only make like 15% guarantee, but then have like an 80% extra risk. So, I think it makes sense to get something more risky after you make some. Take less risks in the beginning.
Right.
It proves itself.
Have like
take
a
more risks.
strategy where whatever profit you make, you take a certain percentage, and then you'll keep some tucked away, and then the rest will go into something a little bit riskier or something like that.
And do both. Own some stocks and sell some puts. You can do both. So if you feel like you've invested too much in this company already, you don't have to keep investing in stocks. You can just do some safe investments, like sell some puts below the strike. So then like you can make like some 30%, 40% profit. At least that's more guaranteed, even if it stays the same. So you can leverage your bets to just either way, not suffer so much. The market might crash, so this way it always gets you in a little bit lower.
So let me just go through. For example, for $15, you need to have your account. Your broker will hold like around $9.30. I mean $930. $900.30, right?
Yes,
$30.
yes. But for some,
and for this you'll make like $200 if you sell them early.
It depends on when you sell them, but if you are willing to wait, you'll make the full amount if Jivo is that price or more.
Okay, but if you don't wait, that's what you're doing. You usually don't wait, right?
I usually don't wait. Yeah. If it hits something that I'm happy with for that week, I take it. But sometimes I get a remarkably good deal, and if I see that there aren't that many rollover opportunities for me, then I wait. I only do it if I think there's a good rollover opportunity. And the thing is, it's tough to roll over at the same time. Like, you know, I'll do it like at slightly different parts of the day. Like when the price is really high, I'll get that maximum, you know, amount that I can like buy in super cheap. But then the price might go down, and then I'm like, oh, this is my time to sell puts. So, you know, I might not roll it over that like the same second, but I'll always try to roll it over the same day because I'm really trying to take this money and make more with it. And if the price jumps, I could lose my chance. So it is like, you know, there's a lot of risks involved. But the main thing here is that you guys see how this works and you guys know what this is, and now you can start playing with it and seeing what you feel comfortable with. But there's clearly a lot of really nice, safer ways to make money on stagnation here, and that's the beauty, making money on stagnation.
So another minus is a lot of iterations. So one minus is you gotta have a capital.
Yeah.
And another minus, you gotta do it like lots of transactions, basically.
If you want to roll over, but you know, a lot of these you can just set it and quit it. Don't even look at it a couple months, and then just cash in whatever day that you feel like. This is a very nice way if you're going on vacation. You can just sell some puts and then not look at anything. It's a good way to do something and then just chill because you know your break-even price. You know you believe in the company. You're pretty sure the price isn't going to drop. You don't have to be so nervous because even if it drops, your break-even is so much lower that you're not stressed about every little drop.
Right. You don't want to lose sleep over it and stuff.
This is way less stressful. For people that get stressed, it's less reward, but a lot less risk. Yeah.
See this for me, like puts in a bull market, I feel like that's a little bit more risky.
The thing is, you're talking about it limiting you, but we're in a market that can crash any second. So this is because everyone is predicting a possible crash. Everyone's talking about a potential bubble. I feel like all of these companies will crash if the market crashes, and when I have a lower break even, I feel like I'm gonna take less of a loss when that crash happens.
Why, Jan, you're saying that it's more risky in the bull market?
Because look, everything's so. What Igor is saying about things coming to an end, it's true. It's probably going to happen very soon. But in general, let's put that aside. The market we've been in since like October, everything's been going up, up, up. So it's like there's a high chance that the price is going to increase instead of go down. So Igor is placing a bet that the stock won't move up much or it's going to go down.
No.
So that is pretty risky.
By selling puts, you're betting for a company. You're betting it's going to go up. You want it to go up. Only if you buy puts do you bet against. This is not buying.
You're betting for it to go up, but you're just limiting the amount. Even if it's go up unlimited, you're limiting your profit.
Yeah, this way you're setting a cap to your profit. But the risk here is very small. This is a very low risk because you make all the money from your break even to whatever the price is then. So you're right in terms of it's risky in a bull market because you might have made more money on your capital. But I don't believe we're in a guaranteed bull market. I believe there is a huge chance of a crash, and I believe that this will provide a pillow for less depression if that does happen.
But like right now, as in today, we're still part of the bull market, right?
I do think that we might be, but because coronavirus is still killing like 4,000 or 5,000 people every day in America, I think that could cause a serious strain on our economy.
Yeah, for sure. Okay, so let's run this because I could tell Oleg too was like we were kind of like hitting some turbulence. So going back to the 15 strike price in May.
Yeah.
Right. So if it goes above 15 by May 21st, we're not making any money.
Making all the money. If you sell that put for like $580, you make all the $580. So you make $580. You make entire premium. You get to keep all that $580.
But you cannot make more than $580.
That's the maximum. Yeah, you can't make more than $580. The maximum you're going to make is $580, but you're only risking 15 minus $580. So you're only risking $920 to make $580. So you're securing yourself like 60% profit on stagnation. So even if the price stays the same, you're making 60%. What's going to bring you 60% when a stock stays the same.
Okay, so hold on. In what case wouldn't it bring you money? So if it goes up, it's going to make you money.
A shit ton of money.
If it goes down.
If it goes down, so once it hits the price point of $9 and 20 cents, then you start losing money. Up to $9.20, you make all the money between $9.20 and wherever it's at, up to 15.
Okay, so this is really okay. It's the puts is what's been really confusing me. Is this what you call a short call?
No, I think you
the
probably
short call is when you buy puts.
You weren't on the call earlier, so when you read the stuff that was on the earlier slides, I posted the slides and I've recorded the video. You'll have a deeper understanding of this because you're just, I think, a little confused because you just missed the beginning of this conference. And what a put is that you are getting this premium. Someone is paying you this premium, and you get to keep that full premium if the price of the stock is that strike price or higher. And then if it's lower than the strike, then what you make is the amount of that premium, just like minus the difference. So you're gonna make whatever your break even is all the way up to its current price.
Yeah, and I think I had the same confusion as you. So what you're talking of shorting is you buying puts.
Yeah, we're talking about selling. We're taking the bet against the company.
Puts, you shorting. When you buying puts, you betting against the company. But this way, when you buying puts, you can lose all your investment. When you're selling puts, you will lose all your investment only if it goes to less than $9.
Exactly.
Right?
Yes.
Okay, so
you're making $0 when it goes to $9, but if it goes less, you're losing money.
Yeah.
But before $9, you just you basically zero at $9 something, 80 cents.
$9.13. Okay, so let me ask you this: break even point is $9.13. I get it. Strike minus last price. Okay, what if it goes up by $5.87?
So basically, it doesn't matter what the price is over 15. If it comes May and it's anything over 15, you get to keep the full premium. And also, as it goes up, the price is going to drop. So you're going to be able to rebuy in cheaper than you sold. So if it goes up to like 20 to 30 range, you're already probably going to be able to take a very significant profit. It's already going to be only like probably $2-3 if the price goes up so high. So it's something you can cash in on whenever you want, and it's something that's bringing you almost guaranteed profit because it would have to go really down. I mean, for it to hit $9, there would have to be some serious issues with the company or a serious market crash. So it's a pretty big pillow you're providing with yourself here. Yeah.
Okay, thank you guys for catching me up. I got that part now, so that's cool.
Oh, no problem. I just want to make sure you
still
get
don't
it.
understand who is buying those puts.
Okay, so
you say like robots, but because the prices are crazy.
I agree. I am showing you guys rare opportunities. Don't expect puts to always be like this. You guys are going to do some research tonight. You guys are going to do some research this week, and you're going to look at the spreads for every company. I want you guys to open Webull, and I want you guys to not only look at stocks now, I want you to look at the option spreads for every company. Every company, always look at the options and always look for these opportunities that I'm showing you guys because we want to find these kinds of opportunities because, yes, robots are not going to be buying these puts forever. I sold some puts for MVIMS at amazing prices. I guarantee you I'm not going to be able to sell those puts that high this week because I looked. I opened my eyes. I saw what the bots were doing, and I took advantage of them. We constantly want to take advantage of these bots and make them buy these really high-priced ask puts that we want to sell to them. Yes. And so yeah, we already went over this, but I'll just recap this because I really want you guys to get this. If you already made 10 to 50% of your total max profit on a put contract you sold, consider rolling it over into a new contract when a higher strike if you believe the company will continue to grow. Example, if you saw put contract price 10 on January 7th, January 14th already at $7, but you notice new strikes are available at a higher price that were not available for, rebuy those contracts for $7. Make that $300 per contract and use that profit to sell contracts at a higher price for a higher strike. You now have a new break-even price that's higher, but it's going to help you if it continues to climb because your overall percentages are going to go way up. and you got 4 choices. And of these 4 choices, selling a put to buy lower is the best. It limits your risk, allows you to own a stock at a lower price. It's a low risk, but still a great reward. I often buy stocks and also sell puts just to give myself a pillow in case the entire stock market crashes. If everything takes a crash, your break even is all that matters. So you own it at that break even price come that date. And you're not going to be as stressed if everyone else is stressed. If everyone wins, you still win. You don't win as much, but you only matters that you're making money and you can sleep at night. So that's me. But if you want to buy some calls and triple your money, quadruple your money, take that risk. There is potential. There is potential. So yeah, now I'll just do like a Q&A real quick, I guess. I know it's kind of been a while, but I really want to help everyone understand something that they still might be confused on. Now's the time. If you're confused on anything, let me try to clarify it.
So I see you showed us like an extreme, like I'm looking at the NVIS puts right now. And so...
You're looking maybe at February. So make sure you look at the March and May. You have to open the tabs to see the different months. So I was showing you May. So what you're going to want to look at May, and that's the same exact screen you were looking at. But the ones for February and March are way less appealing. The price is going to be way lower. That's why I'm recommending the May ones. There's just not as much profit for March, but that's not very far away. That's 1 month, and May is 3 months, so it's going to be a much different price point.
So you're just having to wait until that time frame in order to realize your gains.
Unless it stays the same or goes way up, the put prices fall. The time decay kills them fast. It's you don't always have to wait. I've made a ton of money without waiting. Yeah.
Are the prices of options always changing, like every second, or like?
Yeah. So it all depends on who's willing to buy these puts. For you to sell it to someone has to be willing to buy it, and usually it's bots. And I've done a lot of thinking about this. It's really been a huge topic of concern to me and something I wanted to understand. Who is buying these outrageously priced puts? And it's bots. They're programmed, and they base things on moving averages. And because the moving average right now for GIVO, OPTT, and NVIS is still so low, you look at the 20-day moving average, 50-day moving average, 100-day moving average, it's very low. And these bots see that as a risk. If something is still much higher than its moving average, it could easily go back to its moving average. So these bots are willing to take these bets. They're not basing it on due diligence, research. They're just basing it on mathematical calculations, and you have an advantage of them. You can do research and make bets based on things beyond math, and that puts the bets in your favor. That's who's buying these.
Mm-hmm. No, it's just I need to decide which one to buy now.
So it's been an hour and a half. So this has been great. If you guys have any questions, just DM me.
Thank you so much.
Yeah, anything. I'm really proud of you guys. I think you guys really showed a deep understanding of everything. And Jan,
I'm definitely gonna be doing more research tonight, more into it. But it's like opened the floodgates a little bit for me. So.
Yeah. So do some research. Any questions? DM me. And have a great day, guys.